Yeah, look, some of those stocks, particularly the listed infrastructure plays, have come back quite sharply in the last couple of months. My view is I'm still happy to be overweight that sector of the market. Inflation back in early part of the year, underlying inflation started to undershoot the Reserve Bank's target by up to 50 basis points. Accordingly, the Reserve Bank has responded. They've cut interest rates. I think that the prospect that interest rates remain low for an extended period of time here is quite a real prospect, notwithstanding the fact that the US Fed is expected to lift interest rates probably at the December meeting, at the FOMC meeting. So against a backdrop of the persistence of low interest rates for an extended period of time, as well as the fact that these infrastructure assets, very much in short supply globally. Since the financial crisis, there's been a shortage of high quality, safe assets, and particularly strong quality infrastructure assets. And in fact, the high price tag last week associated with the lease of Port of Melbourne for almost $10 million for a 50-year lease, in my mind, just demonstrates the fact that these safe assets remain in reasonably short supply. Then they should, I think, kind of on the basis of other stocks, they're reasonably expensive, but relative to bonds, in my mind, they're actually kind of still reasonably attractive. And I think that probably represents the right proxy. Sovereign bonds represent the right proxy or the right benchmark for these listed infrastructure stocks rather than other stocks. There's been a bit of press in the last couple of months surrounding the vulnerability of bonds, and the duration of the aggregate bond index, modified duration, has increased quite substantially. And therefore that increases the risks of what the ultimate losses would be in the event that prices fall. But look, that's basically just another way of articulating the fact that the bonds are trading on high price to coupon ratios in the same way that a glamour stock or a growth stock might be trading on a high price to earnings multiple. And therefore, yes, we're going to be more sensitive to increases in the discount rate. But that's just a case of it is what it is. Again, against the backdrop of an environment in which interest rates and inflation are likely to remain low, and particularly in the case of Australia, underlying inflation should be expected to undershoot the target for an extended period of time. My expectation is that these stocks will be reasonably well supported, even if they don't necessarily achieve the high returns that they've achieved over the last 5 to 6 years.